Hello, everybody. Today we're going to be diving into a bigger topic. This is called business financing. Now, this is all about how companies get their money, how they grow, and what they need to get their operations running smoothly. By the end of this video, you'll understand the key methods companies use to fund their businesses and the pros and cons of each one. So let's get started. So, what is business financing? To put it simply, business financing is the process of finding money or capital for a business. This money is crucial because it lets companies invest in equipment, hire employees, create products, and reach new markets. So the first one is self-financing. Now start with something with many small business owners choose. Self-financing, or using your own money to get things started. Think of it like this. Let's say you have saved up some cash, or you have a personal asset like a car or a property that you sell to fund your business. This way, you don't owe anyone any money and you can keep full control over your company. So the advantage is that you don't have to pay interest, you're in full control and straightforward. Disadvantage is that risk is all yours. The amount of the money might also be limited. The second one is bank loans. Next up, we have bank loans. This is probably the most traditional option. Banks offer different loan types like term loans, which are borrowed for a specific period, or lines of credit, where you borrow and pay back as needed, a bit like a credit card. Bank loans usually come with lower interest rates compared to other financing options, and you can often borrow large amounts. The disadvantages is that you will need to meet strict requirements, which can include a good credit score and some collateral like property to back up the loan. Then you have angel investors. Angel investors, these are wealthy individuals who provide funds to small businesses in exchange for share in the company. They might also offer advice or networking opportunities. Advantages is that you get both funding and valuable guidance. Disadvantages is that you will likely have to give up some ownership and possibly influence over business decisions. So let's say you have a tech startup with a new app idea. An angel investor might invest in exchange for 20% ownership. This could help you grow quickly, but this means that you're sharing some part of your company with somebody else. Then you have government grants and loans. So government provides grants and loans, especially for new businesses or specific sectors. Grants are fantastic because you don't have to pay them back. Free money for your business. Loans are also available, often at lower interest rates. The advantages is that grants don't require payment and loans have low interest, and disadvantages is that the eligibility criteria can be strict and the application processes can be very lengthy. Then you have the venture capital. For large-scale startups, there's venture capital. Venture capitalists are professional investors who fund high-potential startups in exchange for ownership. They usually expect rapid growth and solid business plan. Advantages is that it gives access to big capital, and the disadvantages is that you will likely lose some control and be pressured to grow very quickly. Then you have crowdfunding. Crowdfunding raises small amounts of money from many people, usually online. It's a great way to test a new product or gain early supporters. Advantages, it can act as a marketing tool, and disadvantages is that it's very competitive and there's no guarantee of reaching your goal. Think of it as like a board game. A company launching a new game on a crowdfunding site. People who like the idea contribute funds, often in exchange for a copy of the game when it's ready. Then you have equity versus debt financing, the final topic. So equity financing is when you raise money by selling shares of your business. It's like bringing in co-owners. The great part is there's no obligation to pay back the money, but you lose a bit of control. Debt financing is when you take out a loan. You keep full ownership, but you must repay the amount with interest. So in summary, choosing the right financing depends on your goals and risk tolerance. Self-financing and bank loans are common for small businesses, while venture capital might be the best for fast-growing startups. I hope this gave you a clear overview of business financing options. Each method has its own advantages and challenges, so knowing what's best for your situation is key. Thank you for watching this, and if you enjoyed this video, hit the like button and subscribe for more insights on finance. Have a good day.